Hello and welcome to a special edition of The Upside. I'm Kyle Sharapita. As far back as November, then President-elect Trump hinted at the possibility of imposing tariffs on Canada and other countries. Fast forward to late January 2025, and the threat is still on the table. We've compiled a series of Fidelity experts to weigh in and contextualize what this means to the Canadian economy and the Canadian consumer. There is also the residual impact globally of a stronger US dollar. Fidelity is well positioned to understand situations like this because of our diverse asset management teams, vast research resources, access to companies, and experience in prior times of international market impacting news. Now, this is a developing story, so for context, what you'll see today was recorded between January 23rd and 30th. We'll first hear from Alon Collette, Institutional Portfolio Manager on Fidelity's Global Asset Allocation Team, part of FMR, Fidelity Management and Research. The GAA team oversee the Fidelity Managed Portfolio suite of risk-targeted investment solutions, as well as several other funds. Alon is also a former analyst at the Bank of Canada and well-suited to comment on the developing tariff story. So first up, we asked Alon, with all of the news and headlines changing every day, at this point, can Canada and the US avoid a trade war? Take a look.
So this is actually a really, really difficult question. And something that we're going to be following really closely. We don't actually know from day to day how the tariff threats and the threat of a trade war are evolving. And what I plan to do is, in videos like this and in Fidelity Connect's webcasts, with every new piece of information, think about it with our researchers and think about it with my colleagues on the Global Asset Allocation team, and then think about what that might mean for positioning. At present, one of the ways that we're building defensiveness into our portfolios is with a meaningful underweight to the Canadian dollar. And the reason that builds in resilience into our portfolios is, in the event of a further depreciation in the Canadian dollar, and even the depreciation that we've observed so far, if we're underweight the Canadian dollar, we preserve basis points, right? And we build in a smoother ride for the end investor. Again, we believe the direction of travel for the Canadian dollar is lower. A depreciation is our base case, and we're positioned accordingly.
So now let's take a step back and zoom out. We asked Alon to level set. What is the current scope of trade between Canada and the US? And what would the US imposing tariffs do to the Canadian economy?
So Canada and the US have a long-standing, really important trade relationship, right? I think we all know this, but let's put some numbers around it. On the US side, roughly 15 to 20%, let's call it 15 to 18% of imports come from Canada. By far, the largest and most important is on the energy sector. Right, so U.S. consumes about 20 million barrels a day of oil. About 40% of that is imported, and 60% of those imports come from Canada. Taking all those numbers together, call it 15% of U.S. oil consumption comes from Canada. That's probably an oversimplification, but it speaks to just how important that energy relationship is. On the Canadian side, these numbers get really, really much more serious. So a third of our GDP are exports, right? That's a really large part of the GDP, of the growth of Canada. And 75% of those exports go to the US, right? So it's a big chunk of GDP, and a big chunk, almost all of it really is with the US. So 75, 80% of our exports go to the US. Within those buckets, though, within the export bucket, it gets a little sort of chunkier in terms of what products those are. About a quarter of our exports are energy exports. Another, call it 10%, are automotive. Another 14% are consumer products. And then there's another bucket made up of other resources. But the way to think about this is, it is a very, very important driver of Canadian growth, specifically the trade that we do with the US. And for the US, it's a critical input for many of their sectors, but I would say the largest and most significant is really the energy sector. Proposed tariffs would have really detrimental effects, I think, on the Canadian economy. Again, the Canadian economy is already fairly vulnerable. This is something that we've talked about at length and written about. We haven't had much growth since the start of 2023. Households are vulnerable because of renewing mortgages and revolving debt renewing at higher levels. The unemployment rate is already pushing higher. The last thing we need at this point are tariffs and a trade war. And in order to put some numbers around this and some scenarios, it's actually quite hard, right? So again, you need to make three assumptions in assessing the damage from tariffs. The first is you need to make an assumption around what is the level of that tariff, right? Is it 0 and this is just talking? Is it 25%? The second thing you need to do is you need to make an assumption on what's the list of products, right? Is it everything that we export from Canada to the US, or is it just one or two small line items? Again, that affects the magnitude. And then the third one is how long do these last? So how big, what's the list, and how long? In 2019, the Bank of Canada, in their April monetary policy report in box 2, which is on page 24 of the PDF, actually examined this during Trump's first presidency, in which he was imposing tariffs. And they examined using the models that they have at their disposal, and the full force of those models, which really take into account retaliatory tariffs and all the other channels as well, examined the effect of 25% tariff on imports into the US. And the effect on Canada is really alarming. And to bring that to life, I'll give you the 3 key takeaways from that scenario. So 25% tariffs, according to this scenario analysis, would result in a 6% decline in Canadian GDP. I mean, that's very large. To put that in perspective, that's larger than the decline in GDP that Canada observed in the financial crisis, or the recession in the 90s, or the recession in the 80s, right? So very large. The second thing to note is it would result in a 3% upward shock to inflation. Again, that's coming through the depreciation of the Canadian dollar, making those imports more expensive, pushing up the price of those imports, right, and everything, all the goods that we buy generally. And then the third one is a 20 to 25% depreciation of the Canadian dollar, right? This is a function of a flexible exchange rate to make our exports cheaper for the folks that are buying them. But a 25% depreciation of the Canadian dollar from where we sit today takes the Canadian dollar into the low 50-cent range, right? So again, I think this speaks volumes. A 6% decline in GDP, a 3% shock to inflation, and a 25% depreciation of the Canadian dollar. It's pretty serious.
That's great insight. I always love hearing from Alon. So finally, we asked him, if it comes to it, what might Canada's tariff response look like?
Again, this is another exceptionally difficult question to think about. We certainly hope that we get to the other side of this potential threat of a trade war without full-blown tariffs, given how detrimental they would be. But we really need to see the flow of policy and how that evolves in order to really give a concise answer here. So I know this is not much of an answer, but again, we are positioned in terms of defensiveness by being underweight the Canadian dollar. That's a way that we build in some resilience into our portfolios. And given just how damaging tariffs would be on Canada and Canadians, and really potentially the global economy, I would certainly hope we get to the other side of this without a full-blown trade war.
So up next, we'll hear from Ritu Kumra, Portfolio Manager and Director of Research at Fidelity Investments Canada. Ritu manages the Canadian Equity Research Analyst team, who support the portfolio managers and specialize in their own sector of the TSX. This sector specialization allows the analysts to get deep into a specific sector and over time rotate through a variety of sectors so they can grow and think like a diversified portfolio manager themselves. We'll first hear Ritu's insights on tariffs, the Canadian economy, and how the asset management team analyze potential situations like this. Ritu is followed by 4 analysts who cover industrials, materials, banks, and consumer staples. Enjoy.
My name is Ritu Kumra, and I'm the Director of Research for the Canadian Equity Research Team, and I also manage the Fidelity Canadian Long-Short Alternative Fund. With respect to the potential 25% tariffs that have been discussed, there's actually quite a bit to unpack. It's quite easy to say that this is a big negotiation tactic, but our job as investors is to understand our range of outcomes in this scenario. While we do not know exactly what the new administration will do, we are thinking about the potential impact on both a direct and an indirect basis. So from a top-down standpoint, we're thinking about 1, what does this mean for inflation, which impacts both the earnings of our companies as well as the multiple to the extent that there's an implication on rates? Number 2, what does this mean for growth? Does a one-time exogenous shock weaken GDP? Number 3, what happens with the Canadian-US dollar translation? Number 4, will Canada have any sort of reciprocal tariffs? And lastly, if this were to happen, can Canada provide any sort of fiscal or monetary support? Here in Canada, despite stocks being listed on the TSX, we have a number of global businesses. So we're thinking about the impact to the Canadian economy on a top-down basis, but more so the impact on earnings from a bottom-up perspective. So for example, while there may be a demand impact to any given business that sells into the US, we are thinking about the alternative product that the US has to the product in question, and if there is a potential offset or impact from a weaker Canadian dollar. As a result, our analysts have been laser focused on the range of outcomes on a first, second, and third derivative basis. Taking it one step further, while we are focused on the impact to each business, we also need to be focused on the stock. The last layer of what we're thinking about is understanding what is baked into the security in question. So to the extent that there is a view that the range of outcomes will not be as bad as the market anticipates, there may be an opportunity to invest, or vice versa on the short side. I recall back in November when the headline first came out, we had a number of analysts analyze the impact to their respective sectors. And within hours, our analysts had notes come out to the portfolio managers on how to think about their respective funds. As we have received more data over time, the analysis has evolved. And most recently, our analysts have taken this analysis one step further and discussed the impact of the perceived risk of the tariffs versus the actual risk of the tariffs, which is an important nuance when thinking about the range of outcomes. The areas that we're particularly focused on with respect to having a direct impact would be commodities, including energy, industrials, consumer discretionary, and to the extent that there is an impact on the economy, the indirect impact would be, of course, on the financials. The potential impact on the Canadian dollar is an area that we're focused on across sectors. The market can handle good news. The market doesn't like it, but can handle bad news, but it's very difficult for the market to handle uncertainty. And with uncertainty comes volatility, which the team is very focused on capitalizing as the opportunities come up in the market.
So I'm going to talk today about how tariffs impact Canadian industrials. We don't know if Donald Trump is going to put tariffs on Canada and Mexico or other countries around the world. But what we do know is that tariffs have created a lot of uncertainty for the business environment. And so what I'm focused on in my analysis is how that uncertainty could impact the businesses of industrials within Canada. There's some where if the tariffs happen, we know that will be bad, but there's also companies where just this environment of uncertainty could already be infecting them. And to think of some examples, if there's a business in Canada that's thinking about making a capital expenditure, that expenditure might get deferred until there's more certainty on if they'll be able to export to their largest customer. If you're a company that sells large, big ticket items to American consumers or American businesses, and those businesses might have an alternative for your product, it might be more difficult to close that sale until there's certainty in the tariff environment. Conversely, if you're moving an essential good across the border and the tariffs could impact your customers, you might actually see that customer moving more goods right now in order to get ahead of the tariffs, something that we've seen in the transportation environment with some pre-shipping. So we don't know what's going to happen with the tariffs. All we can assess is what the current environment of uncertainty is doing, and it's definitely creating winners and losers within the industrial space, and we're focused on earnings and which companies can thrive through this period of uncertainty.
Bigger picture, there's been a lot of concerns about how tariffs and the stronger US dollar could be impacting some of the different commodities that I research. And a lot of this is because the stronger dollar and tariffs could create some concerns about the affordability of these commodities for customers and how that could impact demand decisions. For example, if you're a farmer in Brazil ordering a ton of potash fertilizer and that's in US dollars, given your local currency, that's becoming a lot more expensive, and you might be reevaluating whether that's affordable or whether you want to consider putting off an application this season. Or if you're a US utility and you use copper products in some of the investments you're making to maintain or build out the grid, and tariffs increase the price of some of those copper-related products, you might be trying to reevaluate certain areas of your budget to try and keep your end bills still affordable for consumers. Within this, though, there's some factors that are making some commodities perhaps, or companies less exposed to some of these risks, and some factors that are increasing the potential risk of tariffs to the earnings growth outlook for certain companies. Some companies where they have perhaps a better ability to pass through tariffs to end consumers, or where there's relatively low shares of production in the US might be less exposed. If you think of a group like uranium, where there's very little US production and the cost of uranium to a utility operating in a reactor is relatively low compared to the total operating costs, might be in a better position to pass through some of those tariffs. On the other side, some companies might be more exposed to earnings risk from tariffs if they have a relatively larger share of supply in the US or they have an asset base that's very concentrated in Canada and they don't have any offsets. For example, the steel sector in Canada could have more challenges given that there's several domestic producers of steel in the US.
So for consumer staples, the large cap companies within the sector are primarily retailers. And so there's not a whole lot of direct exporting going on. The question is about the reciprocal tariffs the Canadian government has talked about. And obviously we would expect a lot of reciprocal tariffs on certain categories or potentially across the board if the US are to implement various types of their tariffs plan. And in that case, what you're going to see is the price on a lot of different items that retailers, particularly grocers, import go up for two reasons. One, the likely depreciation of the Canadian currency, and two, because of the tariffs that are obviously on those products. So where is that going to be most acute? Likely in produce, which is one of the areas that we import a lot, particularly during the winter months. So it would be acute and probably noticeable in the grocery store right away. But in terms of the impact to the companies, grocers have a good track record of largely passing through price increases. We saw that through the COVID era, unfortunately, with the food inflation that I think we all feel. And we've seen that in previous eras where we've seen a significant depreciation in the Canadian dollar going back to 2016. Beyond that, there are some smaller food manufacturers and processors who do have some cross-border business. They would see more of a direct impact from the tariffs. And then outside of that, you may see some impact on some smaller companies as well. But I think the big picture here is the Canadian consumer staples are likely one of the better insulated sectors in Canada. I also cover utilities, which would be a sector that has very little direct impact from tariffs, given its local market, you're not importing or exporting. There'd be some impact to, again, equipment costs, but I think in the grand scheme of things, you can think of them as relatively unaffected.
Well, the range of outcomes is pretty enormous at this point. So in the most draconian case, tariffs are definitively bad for the financial sector, as it will likely lead to higher unemployment, which will lead to weaker consumer credit. It'll likely lead to pressure corporate profits, which will put pressure on consumer credit. And it'll also defer investment in the Canadian economy, which will hurt loan growth. So it will not only lower profitability within the sector, but it will also lower growth as well. So in the most draconian case, that is the outcome. However, there's a lot of mitigating factors that will need to be considered. One, will it actually be placed, will the 25% tariff actually be placed on all exports or only certain exports? If you start looking at various buckets, a very strong argument can be made that it doesn't make sense to tariff certain products where maybe it makes sense to tariff others. And you could whittle that down to 100% to maybe a number that's only 25% of exports, even lower, could be impacted. So that will clearly lower the overall impact on it. The other one is with foreign exchange. There will be likely a weaker Canadian dollar as a result of this. That weaker Canadian dollar will offset could offset a reasonable portion of that tariff. Now, the third one is obviously this tariff may not be in place for 100 years. Maybe it's only in place for a month or two.
Obviously, if it's a very low duration tariff, that's a lower impact than if it's a very long duration tariff. In addition, even the rate, is it 25% or is it 5%? Is it 50%? That will also have a pretty dramatic change on what that impact will be. So the great thing with us is we know our companies very well. We can be very dynamic. This could be a very volatile time in the market. So what we can do is we can adjust on a day-to-day basis based on where market prices are, where the impact is, and adjust our portfolios accordingly. And in general, times of volatility increases the value of stock picking. And that's the hope that we have in this environment, that these times of uncertainty, it's very uncertain what's going to happen. But we do know that every day stock market opens, gives us new opportunities and new chances that we can take advantage of.
Thanks for tuning in. I hope you found that helpful. Again, this is a developing story, and we hope you'll join us again for ongoing commentary. Advisors, our live Fidelity Connects webcasts are every day at 11:30 a.m. Please reach out to your wholesaler for more information on how to register. And for the public, please keep an eye on Fidelity Canada on LinkedIn, as well as our Fidelity Connects podcast, which are video podcast replays of the daily webcast. Those are available on YouTube, Spotify, Apple Podcasts, and more. So one clip we didn't get to include in this show was renowned economist Don Drummond, who joined Connects on Thursday, January 30th. He unpacked Wednesday's Bank of Canada announcement, linking interest rates to the tariff discussion. So please check out that replay. So thanks again for joining us today. I'm Kyle Sharapita.